So, in one word, what does Verve do? We're the company that brings the ads on your phone, meaning whenever you open an app, then it is a high likeliness that the ads you will be displayed will be delivered by Verve. If you look at the overall structure of the advertising industry, there are many, many channels that are very mature, that are occupied by large competitors, and where it's really hard to come in. When Verve decided 5 years ago to concentrate on advertising, on the advertising industry, we decided to focus on emerging channels. So we have a couple of advertising channels that we work in, but most of all, and the most important one, and the one we're talking about today, is mobile advertising. 95% of our revenues stem from this area, and very important here to keep in mind, out of those 95%, again, 95% are purely in-app. So this is important to keep in mind when talking about the threats of AI, of LLMs, of LLMs taking away market share from search engine marketing, because LLMs tend to drive more traffic into apps. So 95% of our revenue comes from this. If you look at how our business works, we have a platform that is active on both sides. Imagine this like being a stock exchange where you auction the profile of the consumer to the advertiser, and in the end, with the bid from the advertiser, you're trying to win the bid on the supply side to finally display an ad. How does this work? Of course, it's not just a platform that you sign on the internet. There's a deep integration of a so-called SDK, a software development kit. This is a tiny piece of software that we install into the apps. So we are part of the apps. And whenever an update of an app comes, then also we are being updated. So this tiny piece of as a software, on the one hand, lets us display an advertising, but on the other hand, also tells us a lot about the consumer. And in the end, our service is not this platform, because this platform is basically a piece of software that would be easily to replicate. But all the data signals we gather from your phone and that we gather from other sources to draw a good picture of this consumer, to increase the likeliness that the consumer is being displayed an ad that's interesting for him, and with this increase the likeliness of him clicking on the ad. So how does this work? The consumer opens up the ad, and then he scrolls down, and suddenly he sees an area where an ad can be displayed. Then we take all the data signals that we gather either from a cookie. Everybody knows cookies. So information that is stored on the phone already, but 80% of iOS users, so meaning iPhone users, do not want to be tracked anymore. And also 20% of Android users do not want to be tracked anymore. In anticipation of this, already 4 or 5 years ago, we started to program AI based on machine learning that lets us know more about the user. I'll come to this on the next slide. But we take this on information from the cookie, the information we gather via our AI, and then enrich it with further data signals. For example, we have search intent data from subsidiaries like Captify that lets us know what this person has been looking for on the internet in the past days. And still, everything we're doing here is fully privacy compliant. Very important. We're not crossing your privacy rights. So we're saying we've got a consumer with this and that profile. Would it be interesting for you? Then we have a vast network of advertisers being linked to our platform, and they start bidding on that profile. In this example here, it's Adidas having the highest interest in this type of consumer profile, and they start bidding $1, they win this auction on the demand side. We take over this auction bid and auction it on the supply side, because also on the supply side there are five, six companies like ours linked to the app. So it's an auction process of both sides. If we win the auction process on both sides, or on the supply side rather, then our ad is being displayed and we're taking the share of the advertising spend. That's roughly 20% share on the market share of the advertising spend on the demand side, 20% of the share on the supply side, and 10% for the auction process. And now this whole process takes less than zero point 0.1 second. And if you think on how, let's say, I don't want to say lame, but it is in the end lame compared to our AI, how a lame an LLM works. So a normal AI that you know from OpenAI or from Gemini, then you can tell that LLM is not the right technology to use in our company. We are focusing purely on machine learning, and that is very important to understand. You will not be able to train your AI on free information from the internet. You can only train your AI if you're in this process, if you're in auctions, and if you're winning auctions. This means all the competitors that are currently in the market are the only ones who can train their AI. If you're not a competitor today, you will very unlikely be able, or not be able at all, to train your AI to an extent to become a competitor in this industry. And this leads to the point that this advertising industry is also about to be locked in the next months and years. So how does our AI work? Besides the AI we're using to make this process work in zero point 0.1 seconds, we have an AI called Atom, anonymous tracking on mobile. And within this zero point 0.1 seconds, it gathers over 100 signals from your phone. Meaning, for example, the way you touch your display tells us something about your age and your gender. Those are just two signals we're receiving. For example, if your fingernails are longer, you will most likely touch the display more flattish, and then you have a higher likeliness of being female. If you swipe across your display very fast, then you're most likely younger than a person tapping on the display with a finger like this, and then you're most likely an older person. But we also have information on how fast your iPhone moves, where it's moving. Is it on a railroad track, on an autobahn, on a highway? Are you driving down a mountain with a most likely with a bike? This tells us a lot on your profile, and this is information that is highly valuable to the advertiser. It's, of course, a fully patented technology. And when it comes to the competitors we have in the market, there is a vast number of competitors. When it comes to idealist tracking, there are only a handful of competitors being able to deliver information from users that don't allow cookies or similar identifiers. And that's why it is for us a huge plus that the ecosystem on mobiles is moving more and more towards privacy, and we are a company clearly benefiting from this. So we take all these signals, enrich them via our technology, put the user into one of 200 cohorts, and then only this information leaves the phone. And that's why we consider ourselves as a fully privacy compliant company where idealist targeting is clearly our DNA. If you're looking at how the company is set up in general, we have 65,000 app integrations so far connected to our platform. If you imagine all the integration work you need to do for SDK integration into the app, you can gather an idea of how big the effort would be for a new competitor to reach a level of ours. So, meaning the more apps you have connected to your platform, the more relevant you get for advertisers. The more advertisers you have connected to your platform, the more apps want to work with you. This led to us having, in the meantime, more than 1,000 large software clients connected to our companies. Those are companies with more than $100,000 in revenue and more than 3,700 clients overall. We managed to grow this number by 27% year on year and more than 7% Q on Q alone. We have 1.1 trillion, that's a US trillion, in German 1.1 billionen, yearly ad impressions and 1 trillion ad requests per year, per day. This shows you how extremely high frequency the trading is we're doing via our platform, and that a normal AI system like an LLM system will not work. It has to be machine learning. From the composition of our business, we're heavily working on growing our demand side. A couple of quarters ago, this was just 25% of our revenue. We're steadily increasing this now quarter by quarter, and the US is our home turf. The US combines about 50% of the programmatic advertising market, and this is by far the most important market, but we're doing very well in expanding our market further to Europe. And one thing you might ask yourself, what about Google, Meta, and Amazon? Aren't they a competitor to Verve? How can they say they're one of the biggest companies in this area? Of course, it doesn't make sense to take the market, including those so-called walled gardens, because they are responsible for the vast majority of this market. But still, the remaining market still accounts for many billions of US dollars on advertising spend per year. And advertisers clearly also want to advertise also outside YouTube and Facebook and co. So meaning those 65,000 apps are mostly very specialized apps, sport apps, cooking apps, weather apps, and it makes a lot of sense for advertisers also to advertise here. And although we have competitors like Google, for example, in the Android system, also outside their walled garden environment, they rank about 10th rank in their own ecosystem, whereas we are ranked number one on the Android system on the supply side currently, as well as on iOS. How did we manage to grow here? In 2018, the company decided to fully focus on advertising. We acquired more than 16 companies over the past years that let us build this unique ecosystem that we currently have. And of course, at one point, we had to unify all these technologies that we included into our new group of companies. So that's why 2025 was a year when a major step was done. We had to migrate all those platforms, 5 platforms on the supply side over a short period of time into one platform. In Q2 last year and parts of Q3 last year, we then managed to melt it all down to one platform on the supply side, as well as one platform on the demand side. That's very important to understand why we had problems with revenue development over large areas of the past year. During this process, we had problems onboarding new clients. We couldn't scale existing clients. The algorithms didn't work perfectly, but it was a really necessary step to undertake, because if you want to grow the company faster, it makes much more sense to further develop just one platform on each side instead of having to develop 5 platforms on each side. This gives us a way more competitive edge in the market. Our algorithms are way smarter now. The whole platform is way performative, and that's what you can see in our Q4 development. Gross margins have increased heavily from Q3 to Q4. We were at about 37% in Q3, managed to go up to 45% in Q4. Of course, there are also effects of seasonality, but you can imagine or you can expect Q1 to not go lower than 42, maybe 41%. There's a strong seasonality throughout the year. The next quarter is always stronger than the quarter before. So Q1 is always the weakest quarter and Q4 the strongest quarter. At the same time, we've increased our revenue on iOS. Remember, 80% of our clients do not want to be tracked on iOS. So you can see our ID list system clearly works. Then on market expansion, we managed to grow our demand side revenues by 61% year on year. We installed a strong growth track on the sales side because now that the technology is in place, it's really important to further grow your revenues on the demand side and on the SSP side. And this goes over just the normal sales process as you know it. So we decided we want to grow our sales force in the US within 1 year from 35 to 150 sales managers, and in Europe from roughly 10 to about 50. And this takes a strong investment beyond what we invest via normal capex. So we had an extra investment in 25 of roughly 10 million euros that goes through the P&L through personal costs, and we will invest another 10 million in the course of 2026. This also as an explanation why our EBITDA margins are not increasing to the extent currently revenue increases. And also on the financial side, 2026 has to be the year for us. We want to show strong improvements here. Margins are already accelerated. EBITDA margins and EBITDA development is picking up. We are already improving heavily our interest coverage ratio. Our total debt of the company is still relatively high for a company of our size, but the investment phase this company had to go through will pay off in the quarters and years to come now. It's a kind of hockey stickish approach that you see, but we're very much focused on growing the company further in the next quarters, and then you will see a natural deleveraging and also a more proactive deleveraging from our side. Important to understand, a new slide I brought you here. Why is cash flow and the net cash still relatively weak, and why was it weaker in Q3 and Q4? It is important to understand that we use attractive payment terms for our clients as a marketing tool. We allow the demand side to pay their bills after 90 days, but we already pay the supply side after 45 days. This cash gap of 45 days leads to a strong increase in net working capital as soon as we grow the company stronger. So we had a strong growth from Q3 to Q4. And of course, this led to a heavy increase of net working capital. Normally, we are able to securitize most of this net working capital increase and with this neutralize it. But following the platform unification, we had 2 quarters where securitization did not work the way we wanted it to work. We could have securitized roughly 20 million more last year. So you have to add this to our cash profile in Q4. But of course, the cash is not gone. It's now just on the balance sheet and it will come out in Q1. So the question is, will it stay like this forever? No, we are pretty sure that as the market matures, this cash gap will compress and will, as our market leading position manifests stronger and stronger, we will be able to convince the demand side to pay a little bit earlier and pay the supply side a little bit later. This is how it works in every industry that matures. One last word on the fears of AI. Currently, we have this fear in the market that AI might make many business models irrelevant. it's really important to keep in mind that AI cannot replicate all those 65,000 hard SSP integrations that we have, that a typical LLM AI will not be able to work as a machine learning AI. We train our AI with 1 trillion ad requests per day and 1.1 trillion ad displays per year. No one can shortcut that. And also when it comes to the question if the downswing that AI gives to typical search engine advertising, this is the open web. If you look at in-app business, no AI is currently able to take market share out of apps, and it even pushes the market shares of in-app marketing further. And in the end, the question, how will agentic AI develop over the years? For us, it's even the case that all the data signals that we have on consumers will be very relevant to in the agentic AI area, and that AI agents will need this information to do their work properly. So we're very curious of how this market develops here, and we are sure there will be new opportunities arising for us. So overall, coming to the last slide here, we have a strong underlying market growth in a multi-billion dollar market. Our customers are shifting more and more of their advertising spend towards our channels. So we're benefiting from a growing share of their advertising wallets. We have strong products in the market that are becoming more and more relevant, and our platform synergies are starting to work properly. And then maybe one last slide here on the KPI development. You see that after the downswing in Q2 and Q3, we're seeing a clear pickup. We have on the first look, it looks like we have lost some large software clients during the platform unification, but in fact, the number of clients grew. Just some of the larger clients weren't able to spend as much money as they were able to in the past, and that's why they fell through this below the threshold of $100,000. They're still there. You can see the net dollar expansion rate recovering, and we're keeping more clients happy than ever before, what you can see on the client retention rate of a phenomenal 99% in Q4. And now I think let's take the last 5 minutes on some Q&A.
Perfect. Yes, we have already a few questions in the chat. So first of all, the outlook for 2026 looked a bit conservative. What's your view on this?
I'm fully aligned with that. From an IR side, it's hard to explain the bottom of this bracket. So if you look at where the midpoint of the guidance lies and what this was implied as growth, this makes a lot more sense as a growth outlook for 2026. I think management was way too cautious here, and they consider the guidance themselves as a very conservative guidance with a robust safety margin, as we say it. So you have to keep in mind in H1 this year, you will see stronger effects of these investments into sales team expansion, because a typical sales manager takes about 9 to 15, let's say 9 to 12 months until he really pays back his own salary. That's, I think, the reason why our management was pretty cautious this year. But most investors and a vast number of our analysts, also you from GBC, tend to stay on the upper side of this guidance brackets.
And you have recently increased the bond further. So why did you do that, since you have already increased the net working capital? And
yeah, the net working capital is nothing
delever?
that we increase intentionally. It happens if you grow fast. And honestly, part of the missed opportunities on securitization were reasons for this bond increase. We could have securitized 30 million more in 2025, and we simply lack this cash. By the end of Q4, we had more than 80 million in cash. This is a good cushion, but in our industry, we want a strong safety cushion to be sure to take all opportunities in the market. It's not that we're aiming for instant additional M&A, but we had deferred payments of earlier M&A transactions. So we had a bit more than 30 million of payout in January, and we'll have another 10 million of payout in October. That's it then for this deferred payments. It has been just a safety measure. The rates we're getting from the market are pretty attractive. So we placed this bond for roughly four Euribor plus 4%, and we managed to have this bond placement heavily oversubscribed within just 2 days. So the market is interested in this company, and that's why we took the opportunity.
Okay, and then there's a question. I'm not sure if I understand it correctly. So in what way does the more traffic to LLMs lead to more traffic going from there to the apps?
Yeah. So that is something you can clearly see in the behavior of users. While they tend to use less Google searches and go more into the Gemini app or the ChatGPT app, at the same time, more and more users use roughly 10 to 15 apps way more frequently. So they're not browsing websites anymore via Google Chrome, but they tend to use the app behind these websites. So me, for example, I use the Chef Koch app multiple times a week. I use the Adidas running app. I use the Handelsblatt app, the Bloomberg app, the weather app, and in all of those apps, ads are being displayed, and those apps are outside the walled gardens. So it is a clear trend that is not just being seen by us, but by market researchers worldwide.
And do you think about share buybacks regarding
Currently,
the low share price? And
Currently, we are not allowed to do share buybacks. We currently have a leverage of 3.0, slightly reduced from Q3 with 3.1. As soon as the leverage is again below 2.5, we would be allowed to do share buybacks again. This is clearly something we're thinking about. Currently, I would say for the next 2 quarters, this is clearly not on the program. But keep in mind that this company also has gaming assets that could result in the company being more focused on advertising. We will see what we do with this business. There are many opportunities for us to deleverage the company on the one hand via a transaction that I'm just trying to, in a way, talk about and not talk about it here, or also, of course, in the way of increasing our EBITDA throughout this year. So once we are at a level of 2.5 leverage, this might be an interesting thing clearly for us to look at.
excellent. So we are all out of time. Great presentation. Maybe finish it with like 10 seconds. Why is now the time to buy Verve as we move on to the next presentation?
Let me say it really openly, the share is completely bombed out. There were a lot of investors that were not happy with that we did another transaction or 2 other transactions of M&A. I think we've learned from this. We clearly want to put cash management and later on the year also deleveraging further in focus. Our technology setup is perfect, and we have a great market position.
Ingo, thank you so much.
Thanks, Matthias.